Here's an ideal structure. You raise $1 billion, you buy Bitcoin, and then you go to the market and you sell $200 million worth of treasury preferred credit instruments, treasury preferred stock, like Stretch.
Yeah.
Like if you just wanted the simplest possible, the equity is high vol, high performance, high risk, and the credit is low vol, and the leverage for the equity comes from the preferred, and the collateral, right? And, for the preferred comes from the equity sale and from the Bitcoin capital.
Right.
And then sell the equity to pay the dividend on the preferred.
American entrepreneur and MicroStrategy CEO Michael Saylor just dropped a blueprint that screams, "The Bitcoin bull rally is coming." In his talk with Mark Moss, Saylor laid out how to build a full-blown Bitcoin treasury company right in this volatile market. The plan? Raise $1 billion, pour it straight into Bitcoin, and lock it in as the foundation. Then sell about $200 million in preferred credit instruments, steady yield products fully backed by those Bitcoin reserves. It's like creating a financial engine where every part runs on Bitcoin. Here's the magic. Equity brings in high-risk, high-reward energy, while the preferred credit gives institutional investors that safe, yield-driven confidence. The best part? The preferred side finances leverage for the equity, which then spins off cash to pay dividends, fueling an endless Bitcoin-based cycle of growth. Saylor's message was crystal clear. This is the future of finance. Simplicity, transparency, and Bitcoin at the center. If big money starts following this model, it will expect a wall of capital charging straight into Bitcoin. According to Saylor, we're not just waiting for a bull rally. We're building the framework that makes it inevitable, and the next leg up? It's already loading. Stay tuned as we bring you more clips from Michael Saylor's interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the rest of the video.
The traditional finance industry is highly regulated, and it has settled into a comfort zone. And, the forces of progression are in the crypto industry. Most of the forces of the traditional finance industry are forces of regression. Like that, the knee-jerk reaction is, why shouldn't we do this? Why is this a bad idea? If you listen to all the Gensler speeches for the last 4 years, it's always why this is a bad idea.
Right.
Like, why can't I issue a token, for my small business over the weekend? Well, we got to protect the investors. Okay, so that's why we're going to disenfranchise 40 million companies from being able to raise money, because the people that might want to invest in them might not be qualified to make that investment. So it's kind of like, well, why don't we give cars to people below the age of 60? We've got to protect the pedestrians, or protect the, it's like if you took that rule and you applied it to phones or cars or websites or flying in an airplane, we would have no automotive industry, we'd have no aircraft industry.
Right.
We'd have no telephones. We'd have nothing, because we wouldn't do anything until we were sure that no one would be harmed by the doing of the thing.
Which is impossible.
We wouldn't even have fire. Wouldn't want someone to get burned. We wouldn't have electricity. People might get shocked.
Right.
Got to protect
Yeah.
got to protect the people that might get hurt by the new idea.
Yeah.
So that's pretty much the existing status quo in traditional finance, and it has been for 30 years.
Yeah.
The equivalent of kerosene in the Bitcoin industry is a treasury preferred credit instrument like Stretch. So on one side, you have digital capital, Bitcoin, and Bitcoin is a long duration, volatile, high energy, high performance source of capital. Long duration, think of it in terms of like 240 months, like 20 years. You should, if you want to get the optimal performance, you can hold it for 20 years. Like it's a 10 to 20 year type investment.
Right.
High volatility, right now it's about 45 vol. Implied vol, it's been 50, it's been 60, it's been 70 vol. And high performance, appreciating 50% a year.
Right.
So that's the raw commodity. What happens if I strip away the volatility, strip away the risk, strip away or compress the duration, translate it to a given currency, and extract the yield? Right? That's what a treasury credit instrument or treasury preferred is. So that's what Stretch is. The idea is you build something that's got 1 month. Like I'm going to give you 10% dividend yield for 1 month. Like the duration is 1.
Yeah.
The yield is 10%. The currency base is US dollars.
Right.
The spread is like if the risk-free rate is 400 basis points, and that's like a 6%, 600 basis point credit spread. I've extracted a 600 basis point spread for the next month in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x. If I, raw Bitcoin is like 1-to-1. It's like if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money.
Right.
But if I 10x over collateralize something, I have $10 of Bitcoin. I have $1 of Stretch. If Bitcoin trades down 50%, I still got $1 of Stretch. If Bitcoin trades down 90%, I still have $1 of Stretch. The statistical odds of Bitcoin trading down 90% are like point something, right? It's a small percentage. So by over collateralizing, you strip away the risk. By structuring it to adjust, if you put a set of adjustments or representations below par, below 100, you start to strip away the volatility on the downside. If, like with Stretch, what we did is we put in a call option at 101, and then we told the market we're going to sell it actively at 100 or better.
Right.
And then we also told the market we're not going to sell it below 99. And if it's below 99, we're going to raise the dividend.
Right.
Okay, so you're kind of collaring this instrument. And then the last point is we created a preferred instrument where we pay it monthly in cash, and then we adjust the dividend every month. We have provided the entire market with a roadmap with all those instruments. You can see how they all trade. You can see the way the volatility profiles come off them. Like for example, the senior credit instrument Strife is traded to a 10 vol. Stretch traded to about a 10 vol. The junior instrument is more like a 20 vol. Strike is more like a 27 vol. The equity is more like a 50 vol or something. So you can actually see that. You can see the demand in each one of them. You can see the liquidity profile. They all do serve different investor bases, so I don't regret having any of them out there. We will let the market decide what their appetite is for each of the four. I would say, in terms of plan, what we know is we won't focus on convertible bonds or straight bonds, junk bonds, unsecured bonds. We won't do that. We will gradually equitize our convertible bonds as they come due. And then if I were giving advice to a new digital asset company, a new Bitcoin treasury company, if you will, I would say you want to raise as much capital as you can. You want to buy as much Bitcoin as you can. You don't really want to have senior debt. You don't want to have debt that has a lien on the Bitcoin. In the ideal world, you might do a convertible bond, but it's not clear to me that you should. If someone wanted to buy a convertible bond from you while you're private, if they showed up with $200 million in cash and said, I'll give you $200 million and I don't want the equity, but I want a bond with conversion right and a 35% premium, I might take that money. That's not unreasonable. Having said that, if you're already trading in the aftermarket, the reason to do a convertible bond is you want to raise a lot of capital in a hurry. But the way you're going to raise the capital is the person that buys the bond is going to sell that much of your equity in 4 hours. So if you sell a $200 million bond, you're probably going to create $150 million of selling pressure on the equity that day. And then the question you'd have to ask yourself is, why don't you just sell the equity yourself? Right? And so a lot of times people that have the convertible bond, they don't have an ATM. Right. So if you're crippled because you don't have an ATM, the convertible bond is the de facto, tri-party ATM, right. But you pay a price, right? You might as well just dump $200 million of your own stock on the market, not owe anybody. The stock will take a hit, but if you do the convert, the stock will take a hit, but you'll still owe the money.
Traditional finance is weighed down by tight regulations that promote caution over innovation, often blocking new ideas to avoid any risk. Officials question why something should be permitted, like a small business issuing a token quickly, emphasizing investor safeguards, which ends up limiting capital access for many companies. This protective approach, extended to other areas, would have halted developments like cars, planes, phones, or basic utilities, as perfect safety is unattainable. It's shaped the sector for decades, favoring stability at the cost of growth. Crypto, led by Bitcoin, brings fresh energy, acting like an early raw resource, a long-term hold with notable ups and downs, but solid gains over time. Tools like Stretch refine it into a steady option by reducing swings, shortening the timeline, and providing returns in familiar currency through heavy Bitcoin backing. This setup guards against big drops, using safeguards like options and flexible payouts to keep things reliable. These options outline paths for the market, showing varied risk levels for different investors. For new Bitcoin-focused ventures, the focus should be on gathering funds to secure Bitcoin directly. Let's watch more clips from the interview.
Here's an ideal structure. You raise $1 billion, you buy Bitcoin, and then you go to the market and you sell $200 million worth of Treasury preferred credit instruments, Treasury preferred stock, like Stretch.
Yeah.
Like if you just wanted the simplest possible, the equity is high vol, high performance, high risk, and the credit is low vol, and the leverage for the equity comes from the preferred.
Right.
And the collateral, right? And, for the preferred comes from the equity sale and from the Bitcoin capital.
Right.
And then sell the equity to pay the dividend on the preferred. You could very well build a $100 billion company from scratch with one credit instrument.
Right.
So if you were to say, what would I do? I would distill kerosene. Is that a big enough market? It's $30 trillion in the US. It's $7 trillion in Japan. Must be $15 trillion, right? Basically, ask yourself, what is the sum of bank deposits, money market accounts, treasury preferred, repo, short duration, treasury credit instruments in any given capital market? I would just, what is the word, skip all the intermediary steps and go direct to the answer.
Yeah.
In my opinion is kerosene is the answer, or in this case, treasury credit. A Bitcoin treasury company is in the unique position to create treasury credit, digital treasury credit. And people are they're going to endlessly torture you and say, well, why should the equity trade at a premium? And the answer is because an operating company can create digital credit. An ETF cannot. And well, why would I, always was well, why wouldn't I just buy the Bitcoin? It's well, I'm not selling to to people that want Bitcoin. I'm selling to people that want 10% bank accounts.
Right.
Do you have a bank account that yields 10%?
No, but I want one.
Yeah. Well, why don't you just buy Bitcoin instead? And that basically tears apart the argument of the short sellers. The reason that people aren't going to buy Bitcoin is they don't want Bitcoin. What they want is a bank account that's high yield. In Switzerland, they want 10%, not 0%. In Japan, they want 8%, not 5, nothing. In Europe, they want more than nothing, right? The beauty of just focusing upon that, Mark, is it's such a simple story. It's I have a company, we own Bitcoin, it's digital capital, we use it to back digital credit, we're selling a credit instrument. Oh, what does it do? Oh, it pays you 5% more than your bank account. Do you want it? Of course I want it. Right, so what's the objection? The only objection is the principal value stable? Right? How volatile is the principal? How risky is it? If it's under collateralized and volatile, you're not going to sell that much of it. If it's over collateralized and stable, in theory, you're going to sell quite a lot.
Yeah.
Right, and just that simple. The largest IPO of the year this year in the United States is Stretch. Is our IPO. You're asking why? Because it's the simplest, most obvious thing. I'm going to give you 10%.
Yeah, the biggest TAM.
10%, strip away the risk and the volatility.
Yeah.
And well, I don't know what'll happen in the future, but I'll just park my money there until I figure out what gives me better than 10%. That's the idea.
Yeah.
And it's a very simple idea. And you can test it. Just go walk down the street and ask 100 people, would you like a stable investment that yielded 10%, tax deferred? And they're like, of course I would. And it's a question of, do I trust you? Do I trust Bitcoin? So you reduce the entire thing down to, is Bitcoin, am I trusting Bitcoin as the basis? And do I trust the company?
Yeah.
And it's kind of like, hey, I have this penthouse apartment, in an island city, and it's beautiful and it's free. Do you want it? And the question is, well, is the island going to sink underneath the ocean? Do I want to live there? Right. That's Bitcoin. Is the granite solid?
Yeah.
And then, oh yeah, who built the building? And then do the elevators work? And
do I trust them?
Yeah. Do I trust the neighborhood? So if I get comfortable with the company and get comfortable with the locale, then of course I want it. It's better than my current situation.
Yeah.
With a money market, you expect to get back down to like one significant digit past the decimal point or something very close. Right. May not be the last penny, but it's, plus or minus, a small rounding error. With a product that's a preferred stock that's trading, you're not looking to get to the sixth significant digit or the third decimal point, but you want to be plus or minus, 10, 20, 30, 50 basis points.
Yeah.
Right? You don't want to be varying by 1 or 2%. You want to be varying by fractions of a percent. And what you offer in return is, okay, I'll give you 5% more yield. And that is just slightly more, it's more flexible than a money market. And you got to go into that. It's not a money market. You got to go into it with your eyes open that money markets are trying not to break the buck, at all. On the other hand, you're targeting something that pays double.
Yeah. So the yield's going to make up for that volatility.
So we're giving you a competitor to the money market that pays double. That will get everybody's attention. That's a simple discussion. Also, the truth of the matter is it's easier to judge whether it's successful or not. For example, Stretch has marched from 90 up to 97 and some change now. And the target is 100. And when it gets to 100, if it were to jerk up to 105 or down to 95, it's not working. But if you look at Strike or you look at Strife, those things could if the interest rates fall 100 basis points, Strife could trade up 10 or 20%. And that's not because it's failing. When Jerome Powell gives a speech and says, I don't really think we're going to lower interest rates as fast, so Strife trades down $3, $4, $5, it could trade quite a bit because of what Jerome Powell said. That's not a failure of our instrument, you see.
Right.
Michael Saylor shared thoughts on how a Bitcoin treasury company could thrive by zeroing in on one strong credit tool, potentially growing into a huge outfit worth billions from the start. He compared it to refining something basic yet essential, like early fuel sources, noting the vast pool of opportunities in everyday savings options that add up to trillions worldwide. In his opinion, these firms stand out because they can craft digital versions of stable credit using Bitcoin as the backbone, something passive funds just can't match. He pointed out that skeptics might wonder why the company's shares would fetch more than plain Bitcoin, but it's simple. The business turns holdings into reliable income streams for folks who aren't after the ups and downs of crypto itself. Instead, they're drawn to steady returns, like accounts paying way above the low or zero rates common in spots such as Switzerland or Japan, maybe double what banks offer, without the wild swings. Saylor explained that the pitch boils down to offering something secure that beats traditional yields, say 5% extra, while keeping the core value steady through smart backing that cushions against drops. If it's not shored up well, it won't draw crowds, but done right, with solid safeguards, it pulls in plenty. He mentioned their own offering as a prime example, the biggest launch of its kind lately, because it's straightforward. Park your cash for a solid return with risks dialed back, and wait for better options. You could check this by chatting with people nearby. They'd likely say yes to a dependable spot yielding well, as long as they feel good about the setup and the foundation, kind of like eyeing a nice spot to settle if it feels safe and trustworthy. As we wrap up, how does the over-collateralization ratio in a Bitcoin-backed preferred stock like Stretch impact its yield stability during market volatility? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.